One wrong choice of business entity can cost you thousands in taxes every year. Let's make sure you pick the smartest one. I'm Alex. When I launched my first venture, I started as a sole proprietor. A few years in, I switched to an S-Corp, and that one move saved me nearly $12,000 in a single tax season. In this video, I'll walk you through the 3 critical factors that decide whether an LLC, S-Corp, or C-Corp is the most tax-efficient choice for your specific business goals. We're going to break down owner draws versus salary, how to maximize the qualified business income deduction, and when fringe benefits and future fundraising plans make a C-Corp the unlikely winner. By the end of this, you lines have a clear roadmap to selecting the structure that keeps more of your hard-earned money in your pocket. Let's get started. First up, let us talk about the S-Corp's biggest advantage, the ability to split your income between a salary and distributions. This is a game changer for many small business owners. When you operate as a standard LLC, you're typically taxed as a sole proprietorship. This means every single dollar of profit your business makes is considered self-employment income. And what does that mean? It means the entire amount is subject to the full 15.3% self-employment tax, which covers both Social Security and Medicare. Ouch! This tax applies right from the first dollar of profit, and it can add up incredibly fast. Now, here's where the S-Corp shines. By electing S-Corp status, you change the game. You are now required to pay yourself a reasonable salary as an employee of your own company. This salary is subject to the same payroll taxes that 15.3% split between you and the company. But here's the magic. Any profit left over after you've paid that reasonable salary can be taken as a distribution or a shareholder draw. And distributions are not subject to self-employment tax. They are only subject to your regular income tax. Let's run a quick example. Imagine your business makes $100,000 in profit. As a sole proprietor, that entire $100,000 is hit with the 15.3% SE tax, costing you $15,300 right off the top. Now, let us say you convert to an S-Corp and determine a reasonable salary for your role is $60,000. Only that $60,000 is subject to payroll taxes, which comes out to $9,180. The remaining $40,000 in profit? You take that as a distribution, and it's completely exempt from that 15.3% tax. In this scenario, you just saved over $6,000. For businesses with profits consistently over $50,000, this strategy can often lead to a 30 to 40% reduction in your payroll-related tax burden. It's one of the most powerful tax-saving moves a profitable small business owner can make. The second critical factor you need to consider is the qualified business income, or QBI, deduction. This is a huge tax break that came into effect a few years ago under Section 199A of the tax code, and you absolutely want to make sure your business structure allows you to take full advantage of it. In simple terms, the QBI deduction allows eligible business owners to deduct up to 20% of their qualified business income right off their taxable income. This isn't just a deduction against your business profit. It reduces your personal taxable income, which can significantly lower your overall tax bill. So, who gets it? This is where your entity choice becomes crucial. LLCs, S-Corps, sole proprietorships, and partnerships are all known as pass-through entities. This means the business profits pass through to the owner's personal tax return, and these are the exact types of entities the QBI deduction was designed for. So, if you're structured as an LLC or an S-Corp, you are automatically in the running to claim this powerful 20% deduction, assuming you meet certain income thresholds and business type requirements. But what about C-Corps? A C-Corp is not a pass-through entity. It pays taxes at the corporate level. Because of this fundamental difference, C-Corps are completely ineligible for the QBI deduction. The owners cannot claim it. This might sound like a major disadvantage, and in many cases, it is. However, C-Corps have their own unique tax feature. They pay a flat 21% corporate tax rate on their profits. If your plan is to reinvest the majority of your profits back into the business to fuel growth, a C-Corp can be surprisingly efficient. You can retain earnings inside the corporation and only pay that flat 21% tax. You'd only be taxed again at the personal level when you take dividends. So, the decision comes down to your strategy. Are you planning to draw most of the profits out for personal use? If so, an LLC or S-Corp will likely let you maximize that 20% QBI deduction. Are you planning to leave money in the company to scale aggressively? The C-Corp's 21% flat tax might be more beneficial even without the QBI break. You have to evaluate your anticipated profit levels and how much you lines take home versus how much you lines reinvest. Finally, let's explore the C-Corp's hidden edge, which lies in its treatment of fringe benefits and its unmatched flexibility for raising capital. While we often hear about the C-Corp's double taxation, where the corporation pays tax on profits and shareholders pay tax again on dividends, there are specific scenarios where it's the most tax-efficient choice in the long run. First, let's talk about fringe benefits. Things like health insurance, dental, vision, and even life insurance premiums. For a C-Corp, these are fully tax-deductible business expenses, and they are provided tax-free to the employees, including the owner-employees. This is a big deal. The other major edge is equity structure. C-Corps can issue multiple classes of stock. You can have common stock for founders and employees, and preferred stock with special rights for investors. This flexibility is absolutely essential if you plan to seek venture capital funding. VCs almost always require a company to be a Delaware C-Corp before they'll invest. They need the legal protections and the stock structure that only a C-Corp can provide. S-Corps, by law, can only have one class of stock and are limited to 100 shareholders who must be U.S. citizens or residents. This makes them completely unsuitable for most institutional investment rounds. So, if your long-term vision involves aggressive fundraising, building a large team with an attractive benefits plan, and eventually going public or getting acquired, starting as or converting to a C-Corp early on might be the most tax-efficient and strategically sound path, despite the double taxation concern. It aligns your business structure with your ambitious growth goals from day one. So, let's recap the 3 key factors. First, the S-Corp advantage of splitting income into salary and distributions to slash your self-employment taxes. Second, ensuring your structure as a pass-through entity like an LLC or S-Corp allows you to claim the powerful 20% QBI deduction unless you plan to reinvest heavily, where a C-Corp's flat tax might be better. And third, recognizing the C-Corp's edge in providing tax-deductible fringe benefits and its essential role in raising venture capital. Choosing the right entity isn't just about saving money this year. It's about aligning your company's legal and tax framework with your long-term vision for growth, profitability, and even your eventual exit. If you now see which structure aligns with your tax goals, smash the thumbs up, subscribe, and turn on the notification bell. We're always dropping new videos to help you build and scale your business smarter. See you in the next video.